when you're in a big cycle like this, the winners are easy to identify because they have visibility. But it doesn't mean the losers are dead mat. But for now, they're kind of untouchable. This should be a good stock picking environment.
Tom Lee has built his reputation by combining traditional market expertise with forward-looking analysis in new asset classes like Bitcoin, crypto equities, and blockchain-powered infrastructure. In this discussion, he lays out a fascinating picture of how investment banks, institutional players, and traditional financial infrastructure are rapidly positioning themselves to benefit from the on-chain economy. This is not just another story about Bitcoin's price. What Lee is describing is the structural integration of crypto into global financial markets, how banks, fintech companies, utilities, and even nuclear energy firms are aligning themselves with blockchain growth.
That AI is the most important driver of the global economy. Okay. But where I think people make an inference mistake, okay, is that a theme driving the global economy has been systematic to the global economy since capitalism
It's always this way.
Yeah, there's always been an industrial revolution.
Okay, fair.
And even in the 80s, the retail sector was the best group for 20 years because boomers were entering women were entering the workforce, and there was a baby boomer thing on retail stock. So that was a single theme of demographics. And like the internet boom was a singular thing of actually creating digital infrastructure. So like it's always been a story of the stock market. So it's only a bubble if spending is not driving income growth. So margins should be shrinking, or debt should be rising faster than revenue. And we don't have a leverage cycle yet, and we have margins expanding. So it's not even late cycle for AI. When you're in a big cycle like this, the winners are easy to identify because they have visibility. But it doesn't mean the losers are dead mat. But for now, they're kind of untouchable. This should be a good stock picking environment because, we know the value that you pay for a creator now has dropped a lot because of AI, whether it's content creator or software.
Developer.
Yeah, people are writing their own apps internally now.
Yeah.
ChatGPT fixing the code. So on the margin, if let's say it's only a 1% change in the demand of something that can cause 20% change in the price of something, we know it's been chipped away.
Okay. So you think the weakness in the enterprise software space is somewhat warranted?
Yeah, and you can probably see it in Silicon Valley, right? They're not funding SaaS companies anymore. They're funding AI startups. That there's many reasons to argue market will expand because the Fed has been on hold all year. So they're neither dovish or hawkish. But if they resume cutting, it's a dovish cycle resuming. That's broadening. The ISM's been below 50 for 30 months now.
Why does that matter?
Well, it's a sign of business confidence. Like the CEOs of these companies, because now I'm chairman of a company, like there's no internal economist. You get your economic view from the Fed and from like Wall Street, right? And so if the economists are cautious, like companies are cautious. That's why the ISM's been suppressed. But that means you're not funding CapEx beyond demand. So expansionary spending hasn't taken place. That's a broadening. And then the third, of course, is that AI, agentic AI, we're kind of moving into the phase where we're seeing useful applications. That means companies are using AI to actually grow their business. That should be broadening opportunities. It's not just
Where are they using agentic AI? Is that chatbots at like an e-commerce site where they're handling customer complaints via an agentic AI, like an agent versus a human agent? Is that what we're talking about?
I mean, I'd say even at Fundstrat, like we're finding a lot of ways now to use AI within the company to make it to run better. Whether it's identifying the source of like why people are having issues or what they don't understand about what we're saying, or how to actually sort of clip things that we're saying to emphasize more information, or even understanding like the source of inbound traffic, like the inquiry. So this is maybe even in the last couple months where I've said, wow, we're really benefiting from it.
Now, that would stop you from hiring a person to manually do those things?
Yeah, I can share a story of a company, but I can't tell you the industry it's in because they asked me not to say, but they're a really big company.
Adult entertainment industry?
No.
Okay. Say more.
But they're really big and use the supply chain. And they said that they were like, they have a commodity that they got to hedge, and they kept losing money on their hedging. And then they were losing money on the supply chain because like they have to buy this commodity and they have to package it and sell it. Then they brought in Palantir. And then they're like, just fed every one of their invoices and all the truck times and literally every trade they did for hedging. And then it just spit out this like series of recommendations. Now they're making money. Their hedging of their commodity is a huge profit maker, and their operating margins have and then they said they have no idea what Palantir did. It's like magic.
He notes that some of the largest beneficiaries of Bitcoin's growth are not crypto native at all, but providers of electricity, industrial equipment, and infrastructure. For example, Solaris SEI builds generators that co-locate with data centers, supporting both Bitcoin mining and AI computing. This dual-purpose infrastructure requires significant capex, but it's where Bitcoin and AI converge as industries. Even more interesting is the national policy angle. Lee highlights TEPCO, the Japanese utility giant, as a case study. TEPCO, once a $30 billion company, now sits at a fraction of that valuation. But with nuclear restarts underway and whispers of Bitcoin mining integration, the stock could experience a major re-rating.
I did speak to Palantir because I saw them at an event, and this is what, so even like our company, which is only 33 employees, but we of course have big asset management and we have tens of thousands of clients, but I was like, could you guys just drop it and like make us better? They're like, just let us do it. And
can you do it for free?
Yeah. But here's the thing. My business partner at Mosaics says that, he has this term called grifting. Palantir eliminates grifting in your business model.
Okay, say more.
What they mean is like they'll find where someone is taking money from you that you don't need in your operations. Or there's too many people in this movement of something and you don't need them. Or maybe internally you don't.
Grifting is harsh.
Well, I know, but it's
inefficiency maybe would be a polite way of saying that?
Yes. Okay. I mean, but that's like a millennial term. Like, because I'm not a millennial. But you know what I mean? Like they're finding how to get you from your revenue to your net income or even more revenue without...
They're the new efficiency expert.
Yeah, and you don't have to be a better marketing. They're actually just saying this is how you should replumb your business. Every company was unchanged and their business strategy was exactly the same. And they didn't have to do anything and face any stress in that 9 years. Then I would be shorting that chart. But look at what happened to all these companies. They had to deal with the 6 kill shots. We have, like as you said, AI revolution, which is really an American story and maybe part China, but nowhere else. So why shouldn't more value be coming into American businesses? So, you know what I mean? Like,
so you're saying we're paying up for companies, but shouldn't we? Haven't all of these companies gotten so much more impressive in the way that they handle? Like, we don't even have recessions anymore.
Yeah, and look at 2Q earnings that just passed 12% earnings growth. Like, if someone said by the end of this...
Why wouldn't you pay up for companies that are this good at finding new ways to pull the profit lever?
And they're growing faster now, 10 years in. I might say that's a good horse, you know?
Well, Tom, one of like the central precepts of the macro, like the macro commentator, is that ultimately profit margins, A, are always too high, and B, are on the verge of mean reverting.
Yeah.
And then they never do.
Yeah.
Which means companies of 2025 are better than companies of 2015 and way better than companies of 1985.
Who would dispute that?
Yeah. See, so
the profit margin mean reversion people dispute that every day when they wake up.
Yeah, mean reversion is too commonly used a word. Like, it's proper in the fixed income world, but in the equity world, there's no such thing as mean reversion. There's winners and losers, right? And remember, in the S&P, like those companies in 2016, out of the 500 in 10 years ago, I bet you 20% are gone. So it's
that's the other thing. It's new. It's newer, younger, better, faster, stronger companies.
Correct.
Right. It's not the same. We're not tracking the same 500 companies over 10 years.
Yeah. If this was the Wilshire 5000, I bet you it's been flat.
Okay. Do you care about this?
Yeah. Why is this bullish?
Well, because remember, this is actually one where there's no one making up the answers. Like, this is a survey that's sent and people respond if things are better, worse, or the same. So it doesn't have any political bias. It doesn't have any
But the answers are biased, no? Like,
the people giving the answers are not necessarily answering the question.
So, but if they're answering it in a negative sense, that means that they're cautious. So you can take their answer at face value. Yeah.
That's what you you don't want this to be like a heavily bullish reading.
Correct. You never had a cycle peak when you've had ISM below. By the way, this is the longest stretch since 1950. When you have this pervasive caution in business, we're nowhere near a cycle peak.
So imagine they turn bullish and they start spending money. You actually were talking to the Bankless guys about this, and this is an important point. Like, everybody's bullish. No, they're not. It might feel that way if you're not bullish.
But why do we have 25 months below a 50 reading on the ISM? Is it because people that answer this survey, what they hate the most is inflation? That would be my guess.
And tariffs now.
Well, that's like they hate tariffs because of inflation.
Yeah.
I think they hate inflation more than anything. So I think that's why you get 4 straight years of below 50 ISM prints.
Yeah.
Okay.
Now, you remember when you are this far forlorn and dejected, and then you flip positive, you won't just go to 50 and then it's over. We're probably going to have 4 years of this staying above 50. I mean, if you look at the history, once it breaks above 50, it's multiple years. But this could be a record stretch above 50.
This is bizarre. Talk through the chart that we're looking at. Like, this most recent episode of the ISM below 50 and the stock market just relentlessly grinding is not typical.
Yeah, I would say like maybe the people answering these surveys are just not terribly important to the economy anymore in the way that they once were.
ISM is still more correlated with S&P earnings than the services index. Because we're more of a manufacturing.
Who are the people commenting for this survey?
So it's members of the Institute of Supply Management. So it's basically the survey.
It's a factory foreman?
But it also could be the Intel, NVIDIA purchasing manager. Although they get one vote, right? They get one survey. A lot of people who work in the financial services industry are actually good, have personal experience of what is happening to the rest of the country, which is Wall Street got disrupted by AI a long time ago. Like, that's why trading went electronic.
It's all
that's
computers.
Yeah. And research shrank what you need because you can just use. So everybody who's worked on Wall Street in the last 20 years has already seen their lives disrupted. And plenty of people survive, but you had to have been adapting to it.
The crypto equity space is no longer a fringe corner of the market. It's becoming a recognized asset class, supported by banks, governments, and infrastructure providers. But with that recognition comes responsibility. Investors must manage risk, avoid leverage traps, and think about compounding, not just speculation. Tom Lee's approach, balancing pure plays, peripherals, and low volatility infrastructure, offers a roadmap for building exposure in a disciplined way. It's a reminder that in a world where Bitcoin is both a volatile bearer asset and a dominant digital currency, the smartest strategies are those that balance upside with resilience.